It is Thursday, February 5th, 2026. And if you are staring at your crypto portfolio right now, I'm guessing you have a really strong urge to just slam that laptop shut.
And go for a very long walk.
Give a very, very long walk. And maybe leave your phone at home.
It is definitely one of those days where, ignorance feels like bliss.
The charts are just flashing that angry red. The fear index is, it's through the roof. And if you're holding HBAR, well, let's just say you're seeing numbers you probably haven't seen in years. It feels pretty grim.
It's a sea of red. We're seeing extreme fear just all across the board, not just in Hedera, but for HBAR holders specifically, it feels pretty personal today.
But, and this is a huge that we really need to wrap our heads around. If you stop staring at the price ticker for just a second and actually pop the hood on the Hedera network itself, the engine is effectively never been running hotter.
That is the paradox, isn't it? That's what we need to talk about.
Right. It feels like we are looking at two totally different realities. On one hand, you have a major corporate restructuring that's changing how the entire ecosystem operates.
Yeah, and on the other, you have national registries moving on-chain, carbon markets getting a massive digital overhaul, real-world stuff.
So that is our mission for this deep dive. We're going to try to reconcile these two realities without, losing our minds.
Yeah.
We need to unpack this whole shakeup with the HBAR Foundation, which sounds drastic.
It does.
And we need to look that scary Chronos fractal right in the eye. And we need to figure out why, if the price is tanking, Hedera is ranked #1 in real-world asset development.
There's just a massive disconnect between the price and the utility right now, and honestly, that's usually where the most interesting insights are hiding.
Okay, let's just dive in. I want to start with the organizational news because honestly, when I saw that headline, it felt like a bit of a red flag. The HBAR Foundation is consolidating its core functions into Hashgraph.
It definitely caught people off guard.
Yeah.
For sure.
Just to catch everyone up, Hashgraph is the entity that used to be Swirlds Labs, right?
Correct. Hashgraph is let's call it the engineering and commercial heart. It's led by the original founders, Mance Harmon and Lehman Baird.
And the foundation was supposed to be this separate thing.
Exactly. A separate engine for ecosystem, growth handling, grants, business development, marketing, all that. The news is that the foundation is now handing those business and development reins directly over to Hashgraph.
The official line they gave is driving market efficiency, which I have to be honest, that usually sounds like corporate speak for we're firing people or, we messed up.
And it's so easy to be cynical about that phrasing, but in this case, the efficiency argument, it actually holds some water. Think about it from the perspective of a partner like a Fortune 500 company.
Okay, so I'm a big bank. I want to tokenize some assets.
Right. Who do you call? Do you call the foundation? Do you call Hashgraph? Do you try to get a hold of someone on the governing council? The feedback they got was that the ecosystem had become this confusing web of entities.
The too many cooks in the kitchen situation.
Precisely. And when you have too many cooks, the meal takes forever to get to the table. This is about having one phone number to call. It cuts the friction for those massive enterprise deals.
That makes sense from an operational standpoint. But I saw some chatter from Brandon. He's that well-known creator who covers Hedera. And he used a phrase that stuck with me. He called it a partial sunsetting of the foundation.
Oof. Yeah.
Sunsetting is a heavy word. It sounds like they're closing up shop.
It is a heavy word, and we need to be really precise here. The foundation isn't just, disappearing into the night, but its role is narrowing drastically. It's now strictly there to support existing grantees.
So if I already have a grant, I'm safe, my project is okay?
Yes. The payments machinery is intact, they're honoring all the milestones, but the era of the foundation being the primary engine for, aggressive business development, that is effectively over.
And what does that signal?
Well, I think it points to a much bigger shift in the culture of the ecosystem. For a long time, the model was what you'd call grant-heavy expansion.
The free lunch era.
In a way, yeah. Basically paying people to build on the network. And that attracts a certain type of developer people who are just chasing the grant money instead of building a sustainable business.
The grant farmers.
It kills the grant farmer culture. Exactly. Yeah. If you were building on Hedera just to get a grant, that free ride is over. It shifts the whole thing from pay-to-play to survival of the fittest.
That sounds healthier long-term. But in the short term, doesn't that imply the money's run out? Usually you stop handing out cash because you don't have any left.
That's the natural assumption, right? But if you follow the money, it's not actually drying up. The source is just changing.
Yeah.
And the geography is changing, too.
We're talking about the Middle East connection here.
We are. We aren't relying on the foundation's treasury just dumping tokens anymore. We're looking at real external capital flowing in. Specifically, we've got $200 million from Saudi sources, $40 million from Qatar.
And that new Dubai fund.
And that recently announced $100 million Dubai-based fund.
Yeah, that's nearly a third of $1 billion. So why the sudden pivot to the Middle East? Is it just that they have deep pockets?
Well, deep pockets always help, but it's strategic. The regulatory environment in the U.S. is still, let's just call it murky.
That's putting it mildly.
Right. But the Middle East, especially the UAE and Saudi Arabia, they've been incredibly aggressive in setting up clear frameworks for crypto and Web3. They want to be the hub. Hedera is leaning into that.
So it's less, here's a grant, please build something, and more, here's institutional venture capital for projects that can actually make money.
Precisely. It signals that Hedera is betting the tech is mature enough now that it doesn't need to be subsidized forever. It has to stand on its own commercial feet.
Okay, so the executives are tightening the ship for institutional business. That sounds logical. But here's the brutal irony. The market hates uncertainty. And right now, this restructuring just looks like chaos to your average retail trader.
Which brings us to the charts.
Yeah, we have to look at the scoreboard. As we're talking, it's February 5th. HBAR is trading around, what, 9 cents? About 8.7 cents.
It's down roughly 4% in 24 hours and over 26% in the last 30 days.
It is ugly. No sugarcoating it.
Yeah.
The fear and greed index is at an 11 out of 100. That is extreme fear.
It's pure panic territory.
And to make matters worse, there's this technical term floating around that is just terrifying people, the fractal. Specifically, the Chronos fractal. Now, I'm not a technical analyst, but fractal usually means history is repeating itself. What is this pattern?
So traders look for these patterns because, human psychology tends to repeat itself in markets. And right now, analysts are seeing HBAR's price action mirroring almost exactly what happened to Chronos, the CRO token, back in late 2024.
Remind us what happened to Chronos.
It was a disaster. I mean, it was the darling of the previous cycle, and then it just ruined a lot of portfolios. Essentially, you had a technical setup called a breakout from a falling wedge.
Which is supposed to be good, right? A breakout.
Theoretically, yes. I mean, imagine you're holding a beach ball underwater. That's a falling wedge pressure building up, waiting to pop. HBR did that. It popped up. But then, and this is the Chronos fractal part, instead of holding the line, the beach ball got punctured, the price rolled over, and it failed to hold the 100-week moving average.
And that is the signal for a crash.
That's the signal that the rally was a fake out. It's exactly what CRO did right before it entered a deep, deep correction. So when traders see that same pattern on HBAR, it triggers a kind of market PTSD.
So that's why the selling pressure is so intense.
It's a feared history repeating.
Okay, so if we are following this map of doom, where are we heading?
We are in the danger zone right now. Analysts are watching the 8.4 cent support level. If HBAR breaks cleanly below that, the fractal suggests a free fall down to the accumulation zone around 4.1 cents.
4 cents. That is basically cutting the current price in half.
It is a very bearish setup. But, technical analysis isn't a crystal ball. To invalidate it, to break the curse, HBAR needs to reclaim the 15.47 cent level. That's the 100-week moving average.
So we need to almost double from here just to be considered safe.
Basically, until it does that, the technicals are saying the path of least resistance is down.
I have to ask, though, isn't this all just a self-fulfilling prophecy?
Yeah.
I mean, does the technology care about a falling wedge?
The technology doesn't care. The nodes don't care at all. But the liquidity cares. The market makers care. And that creates the price. But, and this leads us to the other side of the coin, while the price is potentially looking at 4 cents, the actual usage of the network
is telling a completely different story.
A totally different story.
This is that disconnect we mentioned.
Yeah.
I'm looking at data from Sentiment. They track on-chain data, developer activity, and they have Hedera ranked number 1.
Number 1 in real-world asset development activity.
Beating Chainlink. Beating Avalanche.
Beating them all.
That feels wild to me. Usually development activity and price have some kind of correlation. You build up the best stuff, people buy your stock. Here, they seem totally decoupled. Why?
Because the real-world asset, or RWA narrative, it just takes a long time to mature. It's not like a meme coin that pumps in a day because a celebrity tweeted about it. We're talking about infrastructure. Just look at the foundation that was laid in 2025.
You mean the ETF?
The Canary Capital Spot HBAR ETF. It listed on NASDAQ back in October 2025. I mean, that is a regulatory green light that most projects would kill for. That doesn't happen to dead chains.
And the settlement numbers were huge too, right?
Massive. By Q3 of 2025, Hedera had processed $10 billion in RWA settlements, and dApp transactions grew 386% year over year. The network is being used.
Okay, I want to drill down into one of these use cases because real-world assets is such a buzzword. It sounds great at a conference, but what does it actually look like? Let's talk about the partnership with Verra.
This is a perfect example. Verra is the big dog. They're the world's leading carbon crediting program. If you buy a carbon offset, it's probably been verified by Verra, and they are collaborating with the Hedera Foundation to use the Hedera Guardian.
Guardian sounds very superhero-y, but why do they need a blockchain for this? I mean, carbon credits have existed for decades without Hedera. What's the Guardian actually fixing?
It's fixing the trust problem. The old carbon market was a paperwork nightmare. It was slow, it was opaque, and it was prone to double counting. You'd literally have people selling the same tree to 3 different companies.
So the Guardian stops that.
Right. It's an open source policy engine that digitizes the whole methodology.
Give me a specific example. Where is this actually happening right now?
Okay, take the El Saput Blue Carbon Mangrove Restoration Project in Senegal.
Senegal, mangroves. Yeah. Got it.
This project is restoring mangroves to capture carbon. In the old world, verifying that carbon capture involved, auditors flying out, clipboards, spreadsheets. It took months. This project is the first to automate its entire design document using these digitalized methodologies on Hedera.
So the data from the mangroves, the proof of life, essentially goes directly onto the ledger.
Exactly. It creates a transparent, auditable trail. You can prove the carbon was captured, and you can prove exactly who owns that credit. This is what we mean by the trust layer. It's not about speculation. It's about proving a physical event happened and recording it immutably.
And this isn't just NGOs. We're seeing governments getting involved too.
Yes. We have reports of Georgia, the country migrating its national real estate registry onto Hedera, which mirrors similar moves we've seen in Dubai.
See, this is what I mean about boring infrastructure. A land registry is about as unsexy as it gets.
It is incredibly boring, and that's exactly why it's exciting. When a government puts its land registry on a public ledger, they're not looking for a quick 10x return on a token. They're not Dias.
They're looking for stability.
They're looking for stability and security for the next 50 years. You don't migrate a national database to a chain you think might just disappear in a bear market.
That's a crucial distinction. A government registry doesn't care if the HBAR chart looks like a punctured beach ball.
Not at all.
It just cares if the network is up.
Speaking of up and running, we should touch on the tech updates, because the developers clearly are not doom-scrolling the charts like the rest of us.
No, they seem to be shipping code. We just had a mainnet upgrade, didn't we?
Yeah, mainnet upgrade to v0.70 happened yesterday, February 4th. And the testnet upgrade is happening today. These involved, 40-minute maintenance windows. It just shows steady, active development. The code base is very much alive.
Let's talk about the user experience for a second. If there's a listener out there holding a bag of HBR and decides, you know what, I believe in the mangroves, I believe in the registries, I'm just going to wait this storm out. What's the staking landscape like in 2026?
You have to choose your adventure based on your risk tolerance. If you want safety, you stick with native staking. You can do this through wallets like Hashpack or a ledger device. The big plus here is liquidity. There are no lockup periods.
So you can sell if you want to.
Exactly. If the price spikes and you want to sell, you can. But the rates, they aren't what they used to be.
Right. They've been rebalanced down to what, about 2.5% APY?
Approximately, yeah. 2.5%.
Which is
modest.
It's modest. It's sustainable. It's not an inflationary bribe anymore.
And if someone wants to chase a higher yield.
Then you look at DeFi options like Stater Labs. They offer liquid staking with a token called HBARX. The APY there is currently sitting around 5.61%.
That's more than double the native rate. Why wouldn't everyone just do that?
Because there is no free lunch.
Yeah.
With Stater, you are introducing smart contract risk. Yeah. You're handing your tokens over to a protocol. If something goes wrong with their code, your funds could be at risk. Native staking doesn't have that same layer of risk. Right. Higher yield, higher anxiety.
Mm.
Speaking of costs, I noticed a fee adjustment kicked in back in January. The cost to consensus submit message, which is a mouthful, it went up significantly.
It did. It jumped from $0.0001 to $0.0008.
That's an 800% increase. If my rent went up 800%, I'd be living in a tent.
It sounds terrifying in percentage terms, but let's contextualize it. We are talking about going from 1/100th of a penny to slightly less than 1/10 of a penny.
So it's still microscopic.
It is. Imagine a toll road going from 1 cent to 8 cents. If you're driving a Ferrari, which is what these enterprise clients like Vera are, you don't even notice the change. But what it does do is filter out the spam.
So it stops people from just clogging the network with junk transactions.
Exactly. And it signals a move toward economic maturity. The nodes have to be economically viable. If you want Google and IBM and these large entities running nodes for the long term, the network economics have to make sense.
So let's bring this all back together. We have this massive disconnect. The speculative asset, the HBAR token, is flashing extreme fear, potentially dropping to 4 cents because of a fractal ghost story. But the network utility, the Hedera hash graph, is processing billions in settlements, running national registries, and restructuring to behave like a real software company.
It's the classic struggle of a maturing technology. The market is currently pricing HBAR based on macro fear and technical charts. It's treating it like just another altcoin in the casino.
But Hedera itself is trying to leave the casino.
The restructuring and the institutional adoption suggest that Hedera is trying to exit the crypto casino entirely. That pivot from grants to revenue really sticks with me. It feels like the training wheels are coming off.
And that's a risky moment.
It's a huge risk. When you take the training wheels off, you might wobble, you might crash. That's what this restructuring is. It's a bet that the ecosystem is ready to ride on its own. It's painful, but it's necessary if they want to survive the next decade.
Which brings us to the big question for you, the listener. Are we witnessing the slow death of a popular altcoin, or the messy, unglamorous birth of boring, functional, institutional infrastructure?
And importantly, does the market even care about utility if the chart just looks like a disaster? We like to think utility drives price, but in the short term, fear drives everything.
That is the thought we will leave you with. Is it time to panic over the fractal, or is it time to look at the mangroves in Senegal? Keep learning, keep questioning, and don't let the chart scare you too much. Thanks for diving in with us.
Stay curious.